Accounting concepts or assumptions. Accounting concepts are the fundamental assumptions and propositions within which the accounting operates. They are generally accepted accounting rules on the basis of which financial transactions are recorded in the books of accounts and financial statements are prepared. Means all those rules, all those fundamental assumptions according to which certain generally accepted accounting rules are being formulated, which are used in the preparation of financial records or the books of accounts and financial statements and recording the financial transactions are called accounting concepts. These accounting assumptions or concepts must be followed as they provide foundation for the accounting process. Following are the accounting assumptions or concepts. The first accounting assumption is your going concern assumption. The concept of going concern assumes that business will continue its operations for a long period of time and will not be sold or liquidated in the near future. Means if a business has been started, the business concern will carry on its work for a long period of time, and it assumes that it will not be liquidated. Liquidated means that it will not be closed and its assets will be sold and the liabilities will be disposed of and the business comes to an end in the near future. That is why it is called as assumption of continuity. It is also called as assumption of continuity. On the basis of this concept, fixed assets are recorded at their cost price less estimated depreciation. Because of this concept, fixed assets are recorded at their net values, that is cost of the asset minus depreciation. The going concern assumption inspires and motivates the entrepreneur to work with their full potential. If the entrepreneur himself is doubtful regarding the longevity of the business enterprise, increased and regular earnings are doubtful because he will not reinvest the profit into the business. So it is essential that the entrepreneur himself should work with complete enthusiasm so that the business keeps on running smoothly. And if he himself is doubtful regarding the longevity of the business, then he will not be able to earn regular earnings and he will not reinvest the profits into the business. Classification of long-term assets and current assets, long-term liabilities and current liabilities, long-term investments for obtaining higher rate of returns, etc., will not arise. So if the going concern assumption is not applied, then the classification of long-term and current assets, liabilities, investments will not be possible. The outsiders will not associate with the business for long-term contracts, and all those parties, the outside parties who are engaged with the business, who have contracted the business, they will not associate with the business for a longer period of time. In these circumstances, even the continuity of the business enterprise is doubtful, not to speak of any expansion. and there will be no expansion of the business enterprise, and its continuity may be not possible. Limitations of this assumption are: number one, the financial statements are prepared on the assumption that the business will carry out its activities indefinitely, that is, for indefinite period. These are the main assumption behind the preparation of the financial statements is the continuity of the business. In reality, in any case, it can be seen that business enterprise close down their business activities after giving their financial statements. It only means that the results of the financial statements are misleading. Then second, final position of the business can be known when the enterprise goes into liquidation. In that circumstance, there is hardly any use of such information. When an enterprise liquidates, means is closed, its assets are sold off and its liabilities are paid off, then only, at that point only, the actual position of the business can be ascertained. Second assumption is consistency convention or assumption. Financial statements are used by various users for making inter-period, that is intra-firm comparison, and for making inter-firm comparison with other similar firms. This is feasible only when the accounting policies and practices followed by the firms are uniform, and these are followed consistently over a period of time. So if we want to make intra-firm, that is comparison of different periods of the same firm, or if we want to make inter-firm comparison, that is comparing our own business organization with another business organization, in that case there should be consistency in the adoption of the method of accounting for a longer period of time. To maintain further clarity among readers, there are different methods of accounting of depreciation. For example, depreciation can be calculated by using different methods. Say your straight line method. One method is straight line method and the other is your written down value method. If in one year you are using straight line method and in the other year you are using your written down value method, then the profits will be, the amount of depreciation will differ, resulting into differences in the amount of profits also. In such a situation, the interperiod and intra-firm comparisons are not made properly. It does not mean that assumption of consistency does not allow a firm to change the accounting policies. If the management feels that change in a method will lead to better disclosure of financial performance of the business, it is free to adopt a change. So, consistency in adoption of the method of accounting does not mean that in no case the accounting policies will be changed. If the management feels and it is necessary to change the accounting policy, then the accounting policy may be changed. The management is free to change it. However, the necessary change of method along with justification of change must be stated in the footnote to enable the users of the stated change. The only thing is to be done is to mention the change in the footnotes to the accounting to the financial statements. Need. This assumption is important as a basic assumption of accounting because it helps in decision making function of the management. By help of this assumption, the management gets help in its function of taking decisions. It also helps other users of accounting information to make decisions related to their interest. And the other users of accounting information can also make decisions as per their own interests. Then its limitations are there are several methods for different methods, and it is not possible that all the entities in the same trade use the same technique. So different techniques are there, different methods are there, and it is not possible that all similar firms use the same techniques. To overcome the above limitations, it is necessary that any changes in the policy of the company or financial statement should be well informed to the users, and the method once adopted by the entity should be followed by them at least for some years so that trend of the operational efficiency can be evaluated. And if there is any change in the method, it should be informed to the users, and that change method should be used for some years so that trend of operational efficiency can be easily evaluated. Then the third assumption is your accrual assumption. As per accrual assumption, revenues and expenses are recognized in the period of their occurrence rather than when they are received or paid. All your revenues will be recognized at the period when they have been earned, and all the expenses will be recognized on the date they have been incurred. Thus, and not on the basis of actual cash paid or actual cash received. Thus, revenue is recorded when sales are made or services are rendered and not when cash is received. Similarly, expenses are recorded in the accounting year in which they have occurred, even though cash is paid in the next accounting period. Means all your outstandings and all your accrued outstanding means the expenses which were due to be paid in the current year but not yet paid, and accrued means the incomes that were to be received in the current year but not yet received will be accounted for. Need. The basic objective of accrual concept is that earning of revenues and expenses, that is consumption of resources, can definitely be related to a particular accounting period. Your earning of revenues and expenses are to be accounted for a particular accounting period. So revenue and expenses should be considered as earned and incurred respectively on accrual basis instead of cash basis. So they should be taken at accrual basis, not on cash basis. Limitations. The main limitations of accrual concept are: number 1, allocation of revenue and expenses between different years on the basis of accrual. Accrual is a time consuming process. It is a time consuming process. Second, In the case of goods sold on the basis of hire purchase system, the amount collected in each year as installment is treated as the revenue realized. In hire purchase system, whatever amount is collected in form of installment is treated as a revenue during that particular year instead of selling price.